Welcome to the latest episode of Renovating Retirement with Charlie Jewett and Bobby Alford. This show confronts the retirement planning industry and reveals all of the tricks, lies, and scams the stockbrokers, insurance agents, and financial advisors use to steal money from consumers. In addition, Charlie and Bobby will teach you everything you need to know to make your own financial and retirement decisions and live the retirement of your dreams. Now here are your hosts, Charlie and Bobby.
Hey everybody, welcome back to the Renovating Retirement Podcast. I'm Charlie Jewett and have Bobby Alford here with me, and we're going to talk about or continue our series on cash and investment strategies for real estate investors. And just so you know, if a real estate investor is somebody that owns any home, even if it's the only home you live in, you don't rent out any rooms or anything, you are a real estate investor because you're paying for something that appreciates. Now, you might have multiple properties, that's fine. You may not even own that first home yet and want to be. All of that is fine. This episode is going to help you because we're going to talk about the most misunderstood asset class in the entire country. And Bobby, you've learned from me over the last year or two. What is the most misunderstood asset class?
Well, first, what is the most held asset class in the world? And it's mostly home ownership, right? That's the biggest asset in people's lives. So if that home ownership develops into an asset class, then that becomes the most held asset. And that asset is equity. Exactly. And the most misunderstood asset is equity. And that's what we're going to be talking about today.
Exactly. And there's a lot of words in the securities world, even that word's confusing because securities aren't secure. But in the world of investments and stocks, bonds, mutual funds, there's a way of saying equities and securities. We're not talking about that. Home equity, or with real estate, equity really is defined as the difference between the value of the house and what you owe. So the profit that's built into the house. In theory, if there were no fees at all to buy a home, and you bought a home for $300,000 and you put your own $300,000 inside of the home, you would have $300,000 in equity now instead of having it in other investments or wherever you got it from. There was $300 over here, you moved it in, and now it's sitting here. If you buy a home with none of your own money, 100% financing, and home's worth $300,000, and pretend there's no fees, and then you use somebody else's money, you leave your $300,000 alone, you buy a house. Over the next 2 years, it appreciates 3-4 years, whatever. It's now worth $400,000. Forget amortized loans and all that. Say you owe $300,000 and it's worth $400,000. The equity, what we mean by that word, is the value inside of the home, the dollars that are there that you could have. Yes, you'll have fees to sell the house, real estate costs and all that. Forget that for a moment. Just equity is the difference between the two. Let's just call it that for simplicity here. Does that sound fair, Bobby?
Yeah, the easy way to think about it is if I sold my home today, whatever I could sell it for, take all the fees out of the conversation. Whatever I could sell it for minus what is owed is your equity. And so whether you've paid all cash and you owe nothing, therefore the whole thing's equity, or like you said, $300,000 mortgage, it's gone up to $400,000. If I sold it today, $100,000 in equity. So that's my basic way of understanding it.
And this is my passion, man. This is my baby. This is where I started. This is what I wrote my first book on. This is how I found the industry. So Bobby's going to share a picture from my book. And the book is only 28 pages long, 2 Ways to Be Debt Free. You can get it at renovatingretirement.com at no cost. Just download the PDF. The book has changed thousands of people's lives. And it really was me taking a 550-page book called Misfortune, and then the 250-page version of that book called Misfortune 101 by Douglas Andrews, my first mentor, and saying, how do I make this easy? How do I just, if it's good for people, how do I just say it in the fewest words possible? And created this little conversation called the 2 Ways to Be Debt Free. Now, I found investing or investment strategies, I found the retirement services industry by being in real estate and mortgages. I had 80 loan officers where my job was called business development manager. It's a fancy title like petroleum transfer engineer if you pump gas, right? Business development manager basically just meant there's 80 loan officers that my boss wanted me to have them sell more and like go figure out ways for them to sell more. So I went and studied all the loan officers, mortgage professionals in the industry that made $1 million a year or more. and found something I wasn't looking for, Bobby. I discovered that the best mortgage minds, the best mortgage professionals did not see the mortgage transactionally, like sell it to somebody. They saw it as this huge piece of someone's financial plan. It had interaction with the tax plan and with the investment portfolio, because whatever down payment you make, you're killing those sheep. You're taking them out of investments and they stop earning interest, and there's a loss of earnings that's not tax deductible. You don't get a tax write-off for no longer earning 7% on $200,000 because you've taken it out of investments, put it inside of a home. So it affects taxes, the size of the mortgage you have, the limitations. So the best loan officers and mortgage professionals were seeing this as a part of the financial plan, and I fell in love with that. I thought it was incredible. I paid a guy $6,000 to go see him teach a class live for 3 days, and then I went and paid a lower fee to see it 6 more times, But what I learned from that was what we have here on this picture, the 2 ways to be debt-free. Basically, it's this. When I studied wealthy individuals, businesses, non-for-profits or not-for-profits, I found that they don't follow Dave Ramsey and Susie Orman. They don't follow the traditional advice from 1929, 1933, 1935. They've actually grown. They've paid attention to the data instead of what's comfortable and traditional, and they've really looked at the math of it. They don't try to pay off their real estate. They don't try to force equity or put their equity inside of houses or buildings and let it sit there until they're dead or until they retire. And the reasons are pretty powerful. But I wrote this book, The 2 Ways to Be Debt-Free, because there are 2 ways on any piece of property to be debt-free. One of them is to be liability-free. That's the trend, the traditional model, traditional method, the one that's taught mortgages are bad. You should try to pay it off. Make a big down payment. Make extra payments every month because look how much this debt's going to cost you over 30 years. Ooh, boo. And then, a 15-year fixed mortgage with a bi-weekly payment that the bank sends you that little advertisement on. You're making 26 payments a year instead of 26 half payments instead of 12 full payments. So there's an extra, yada, yada, yada. All of those strategies come from looking at one half of the equation and not the other half, saying, what is it costing me over 30 years? None of them ever address the most important thing is every dollar I choose to put into the home to save that cost over 30 years cannot earn compound interest over the same 30 years. They never address the opportunity cost of the money or on the money, okay?
Yep.
So one way to be debt-free is to put all the money you have, slowly or quickly, into the building, the property. Here, let's talk about quickly. You have $500,000. You buy a $500,000 house. You put all your money in. Your money no longer earns interest. It's all in the form of equity. You have the house with no mortgage, and now it's sitting there until you sell or die. Okay?
Mm-hmm.
What I found in studying, not following, I don't like traditions that much because traditions make people blind. They stop questioning it. This is just the way we do it here. But why do you do it that way? Does it still work? Who said it first? Who gets paid, right? Why? Where did it come from? Is it still good for you? The traditional way, I found people weren't following it. The smarter they were, the more knowledge they had, the better advisors they had, the more money they had, they weren't following it. And why is that? Because liabilities are not the enemy. How do we know this? Let me give you an example. Pretend you're looking at a bank and there's 2 windows on the bank. And those windows are advertisements. The window on the left says 1% CDs. We'll pay you 1% to put your money into CDs at the bank. Okay? The other window says car loans, 4%. Well, what money are they using, Bobby, to lend you? Like, where do they get the money to lend you money to buy a car?
Well, they got to start with money, and they get money by having you put it into CDs.
Right. So we give them $100,000, and if you really want to study the nitty-gritty of banks, they're allowed to lend 9 times. They're allowed to lend $900,000. There's a leverage involved. So you give them $100,000, forget the leverage part. They have $100,000. They're paying 1% to rent it. That's the liability. And Dave Ramsey and Susie Orman would go, boo, you shouldn't have debt. Look how much the 1% is going to cost you over 30 years. Cry, get a violin. No. How about we get a calculator? That's stupid. And laugh and smile all the way to the bank, not cry. Do what the banks do, not what they tell you to do. And certainly not what people with outdated information from 100 years ago tell you to do. They take the money. They rent it from us at 1%. They lend it at 4%. they're making a, what is that, 300, 400% return on investment, whatever that is, right? Hundreds of percent. They're making what's called an arbitrage. The greatest rate of return in the entire financial services industry is arbitrage, renting someone else's money at this tiny little payment, but you get all of it and you earn interest on all of it and you earn the spread.
And we're going to go into that in detail in further episodes.
The next episode, we're going to get into how to earn 70 to 100% rate of return on your money through arbitrage strategies, which, by the way, you hear the word arbitrage, you're like, what is that? It's wholesale retail. It's what every single retail store has proven works. You buy low, you sell high. That's what Walmart, Target, Sears, whoever's still in business, all these companies, right? Like, that's what they do. Amazon, let's pick somebody from the modern era. Amazon, that's what they do. Costco, right? You buy at a lower price, you sell at a higher price based on convenience or bulk purchasing or whatever it is. Arbitrage is the financial version of that. It's the cousin of wholesale retail. We'll get into that in the next episode. So banks exist to go into more debt. That was the first thing that gave me the big aha. They want liabilities when they're cheap. When the interest is low, they will borrow as much money. If I call up a bank and say, I would like to give you $45 billion and put it into your CDs. Mm-hmm. I don't know if there's some other rule where the bank would have a limit or whatever. Some insurance companies have limits on how much money you can put in annuities. I don't know. I've never offered a bank $45 billion. But my guess is I could find 45 banks or 100 banks or 500 banks that would eventually take some piece of it. They want more debt. Insurance companies are exactly the same. If you look behind the scenes, they're basically putting your money into bonds and earning 5 or 6%, keeping 1 or 2 and paying you the rest. Well, they're paying you. That's debt. They're servicing the debt by paying you interest, but they're earning more than they're paying you, and that's where the arbitrage is. So both banks and insurance companies, the biggest financial institutions in the world, exist to go into debt and pay commissions or salaries to people like Bobby and I, the 1.5 million. I don't know if there's still 1.5 million insurance licensed people in the country or if my numbers are wrong, but there's over 1 million financial professionals for sure. They get paid to help the smartest and largest financial institutions find more debt. Mm-hmm. Why? Because the other way to be debt-free on anything is to have a liability and have all the money to pay it off whenever you want to. So in one account or in one pocket, let's say you owe $300,000 to somebody. Now, you have the $300,000 sitting somewhere else and you could write the check. You could be out of debt. There's no slavery. It's no like, oh, debt is so bad, it ruins your life. Not really. Debt that you can't afford or pay off ruins your life, but debt that you could pay off whenever you want to and choose not to because you're making so much money, that's not slavery, right? So if you have $300,000 sitting in one account and you have a liability somewhere for $300,000, when you put them on a balance sheet, you list negative 300, then you list positive 300. You know a lot more about balance sheets and selling companies and exit strategies and running businesses and blah, blah, blah than I do. You know, these balance sheets, when you add them together, negatives and positives, it says 0 at the bottom. What my book, the 28-page book, is teaching is just being debt-free on a home with the balance sheet method, keeping a liability that you can pay off. Yep. Or racing as fast as, if you're going to make an extra $300 payment every month, don't make it against the cheap debt, pay it into the equity savings account that's earning 5, 6, 7% tax-free. Build up your asset, not pay down your debt because the debt is actually good. You want more of it like banks and insurance companies do. And so sure, make extra principal payments, but make them to where? Sure, make a large down payment, but where? Into the house or into your own account where it compounds tax-free? So Bobby, the two ways to be debt-free that we're seeing on the screen here are you can either have a house worth $500. By the way, I did business in California and Hawaii only for many, many years. Now we're in all the different states, but my numbers are high. If you live in Idaho, you might be like, what? Right? Yeah. So $500,000, you could have a house for $500,000, have all your money sitting inside of it dead. You've killed all your sheep. You're not earning any interest. There's low liquidity, low safety, no rate of return, and no tax advantages for that model. It's basically a very inefficient inheritance plan, like an accidental inheritance plan. When I die, it doesn't need to multiply. I'm not going to use life insurance, and just whatever this house is worth goes to the kids, but I don't need to earn any interest on the money that's sitting inside my house until that day. That's what you've got here. The balance sheet method says if you're allowed, owe as much as you can, owe a bank $500,000 on that house if you're a veteran, let's say, and have the $500,000 sitting outside in an equity savings account, which will teach you how to build one, earning 150% of what it's costing you, 200%, 300%. If you can borrow at 3 and earn 6, you're making a killing, right?
Right.
Had you heard of this before bumping into me at all, Bobby?
I had not. No, and let me go ahead and back it up a little bit, because in his book, which everybody needs to read it. You don't have to work with us to read it. Go to renovatingretirement.com, download the book, 28 pages. It's gold. It distills all this knowledge into something that you can digest in a couple hours. Now, here's some important things. How did we end up with the traditional model? When Charlie went back and did the research, it comes from our parents who learned from their parents and so on. Depending on how old you are, your parents or your grandparents were alive in the Great Depression, or great-grandparents, if depending on when you listen to this. At that time, the mortgage industry had a different legal structure. And when things started going south and the banks could call in notes, even if you hadn't missed a payment, the banks could call in notes and make these people homeless. So you're in the worst depression that our country had ever seen. And your family, somewhere in the generations before you, were kicked out of their homes for doing nothing wrong because of the contracts the banks had leveraged themselves into, the predicament that they had done, not your family. And that is a takeaway to say, okay, banks can do fractional lending. Conversation for a different day, but that puts them at risk. When the bank was at risk and the market went down, they called in their notes. Could your family pay their house off in full at that moment? Most likely not. And thus they were kicked out of their home and it was repossessed. Now, what does that do for our families? Well, trauma in our family gets passed down. They taught their kids, never be in debt. Debt's the worst thing ever. You could end up homeless. Pay off your home. You have to do it. Otherwise, you could be kicked out. And so that became gospel. And Charlie succinctly lays this out in the book. But that became the rule. And nobody looked back to see if anything had changed. Well, throughout the mortgage industry, eventually, and Charlie, you can give me the date, but eventually the code changed. And they could not just take your home back. And it came down to you had to be a delinquent payer or miss payments, things like that, in order to lose your home. And therefore, when that happened and they could not just kick you out and make you homeless, the landscape changed. And then debt did not become evil. Debt became a way to leverage yourself into wealth. The people who will never pay off assets like this, BlackRock, largest firm in the world, Donald Trump, Robert Kiyosaki, Grant Cardone, any large real estate investor you can imagine who owns properties will never pay them off in full. It does not make logical sense if you dive into the math. Debt is not bad. It is not good or bad. It is an instrument that can help you or hurt you if you do it improperly.
Right.
And what we build here and what Charlie has taught me is an equity savings account, leveraging your home value, putting, as we've said before, your largest asset, putting it to work for you, becomes a game changer in retirement and wealth creation. So I don't have any, other than that, I don't have any strong feelings on this.
Exactly. We talked about on the last episode, and we're going to hit it over and over and over again. What you get with proper equity management or proper use of real estate, you could have I think we had 4 increasing incomes for one fixed payment, where you're paying the fixed payment with depreciating dollars, which means if your payment is $3,000 a month, the payment you make 10 years from now costs a lot less because of inflation, and the payment you make 30 years from now is dirt cheap. But you buy a house, let's say it's worth $400,000, and you have a fixed payment. Well, the $400,000 appreciates every year, and when it's at $450,000, you're making money on $450,000. When it's at $500,000, you're making money on $500,000. You're always making appreciation on a higher number. Let's say appreciation is 5%. Earning 5% of $550,000 is better than 5% of $400,000. So that number always goes up. If you're doing any rents, even if it's just single rooms, rents go up over time. Nice, okay? If you're separating your equity, like we're going to teach you, if you're doing what banks and insurance companies do, you're using arbitrage strategies, and you're not killing your sheep, and you're not leaving equity dead sitting inside of houses, but you're renting it, paying to employ it the way that banks pay for CDs, that account earns interest, compound interest, which means it gets bigger and bigger and bigger. You're making more and more money on that one. And if there's a fourth one, I forgot what it was. Oh, the depreciation, is it?
Taxes alone. Like if you have your own primary property, depreciation, rental properties, depreciation, even racehorses have depreciation, which blew my mind.
Wow.
But the idea is that the IRS is incentivizing you to do these things. and they will reward you. So tax savings, i.e. mortgage interest write-offs, that's one. Depreciation, working out and recouping the value of the asset over time from your taxes. You're lowering your tax bill every single year. That's another. Obviously, incomes and as those raise. So you are paying a debt long term with less and less valuable dollars because they get stolen to inflation. We print money like crazy. All these things are just facts. And as inflation goes up, the value of that dollar goes down. The bank knows you're paying them with cheaper valued dollars for taking that money today and putting it to work for you. That's a longer conversation. But the last thing I wanted you to hit on, Charlie, is what's the downside of the traditional model where the equity is in the walls of your home and you've paid off your home, and like I like to imagine $100 bills lining my insulation around my house. What are the limitations to getting that out later on in life?
I feel like I've seen that on Netflix somewhere. What was that? Which show was that? Was that Animal Kingdom? Was that Breaking Bad? Which show was that? I mean, there's so many limitations to home equity, and this really started with an honest question I learned from Douglas Andrews. Is like, how do you measure home equity? Just use the same measurements you use with other investments: liquidity, safety, rate of return, and tax advantages. The number one risk is it's not earning compound interest. It's sitting there, not invested anywhere. You earn interest based on appreciation of the value of your home. The dollars you put it, you can say, if I pay $200,000 to the bank as a down payment on a $500,000 house, I pay $200,000. I give it to the bank. They lower my mortgage. How much interest do they pay me to use my $200,000? The answer is zero. Technically, you're saving the tax deductible mortgage cost of 3.5, 4, whatever it is. So you could say that's the rate of return, but that's very, very low, right? Mm-hmm. You make a down payment, the house appreciates. What money's lost first? Your money. You put $100,000 down on a $500,000 house, goes down 20%. You lose your money first and can't even get it with a sale, so it's not safe. Your house is destroyed. New Orleans, Jersey Shore, fires in California, wherever houses are destroyed for whatever reason. I actually have somebody that was scared to live in a certain place because of sinkholes. That sounds like a movie, man. Sinkholes. I think it was Florida. What, the Florida? I think it was Florida, right? So
that's
sinkholes.
Like a Dwayne Johnson movie.
It does sound like a Dwayne Johnson movie, right? He only does 12 movies at a time. I wish I could invest in him. Is there a Dwayne Johnson stock? Can I depreciate Dwayne Johnson's horse at the same time?
The Rock Fund.
The Rock Fund. Welcome. What's the ticker signal? Rock. Obviously. R-O-C-K.
Obviously.
Get it. Obviously. Or bicep, which is too many letters, whatever. Right? Lat with 2 T's. Abs with, there you go. Stop, Charlie, stop talking about the Rock's muscles. So it's not safe. It's not liquid. You can't borrow the money easily, especially if you don't have a job. It has no rate of return, or at best, it's saving you a tiny little cost that every smart institution actually wants and pays commissions to get more of that tiny little cost. And then you're crushing your tax advantages. People don't know this. The lowest you pay a property down to, you permanently lower the tax deductible mortgage you're allowed to have on that house. It's called acquisition indebtedness, which we'll get into. Now, we're going to get into where do you put the money? How do you borrow from that with no payments to reinvest it again and be earning money in 3 places on the same dollars? How do you use opportunity zones to save money and taxes? What if you get to the end and it's worth $25 billion and you want to sell? Don't you have a capital gains problem? Deferred sales trusts, if they're still around at that time, or whatever technology exists to avoid, control, postpone, or perpetually postpone capital gains taxes. But we're not, all that advanced stuff is fun, but the basics, what I used to do mortgages before I was even an insurance agent, before I studied taxes and estate planning, when I did mortgages, I'd say there's 2 destinations here, right? You can either end up with all your money stuck in a house, or you can end up with a whole bunch of money in an account earning interest that's safe, where you could pay off your mortgage, but you choose not to. Where do you want to end up? The beginning of all these decisions, even if you want to have 100 or you already have 100 rental properties, is where should my equity dollar be? Should it be in the house where I'm losing 7% tax-free compounding and can't write it off? Or should I try to get it into a situation where I'm paying 3 or 4% tax deductible and on the same money earning that 7% tax-free? Yes. The answer is yes. If you can think outside the box. Am I saying that this way is easier? No. I'm saying it's safer, more lucrative, better in every way. simple is not always better. I don't want a simple spaceship. If it's supposed to take me to the moon and back, I want it to be quite complicated, okay? So
Right.
that's, well, now I can say, other than that, I don't have any strong opinions on the subject. Hey.
Yeah, and let me paint the last picture that really helped me understand this. And I was working with my parents. They have a wonderful home in Florida. It's worth quite a bit of money, and we were planning out their next 100 years, because of course they're going to live 100 more years. And we started talking about, they want to pay off the home. Here's what's going to look like. Blah blah blah. Started talking to bankers, found Charlie in this process, but started talking to people about getting a loan for their home equity. Because the adage was, if I ever need it, I can tap into that for long-term care or getting, taking care of a spouse later on in life. And what we learned, and what Charlie teaches, is that banks don't want to loan you money on your home equity because they don't want to own your home. They only want to be paid back with interest. So if you don't have an income stream, as most retirement people, most people that are retired or plan to retire don't have an income stream, they just live off their accounts, banks don't like that. They think that is a risk because you don't have an income stream. There's a good chance you can't pay them back if something were to happen. So that entire bubble of the concept popped when we thought, oh, wow, we become a bad risk for the bank, which blew my mind. We become a bad risk for them to loan us money. So if we can't get our equity out in order to make sure we live and my parents are taken care of and all those things, we've got to really think about this differently. Because it's either A, your house is worth too much and you can't get a reverse mortgage above a certain amount, or B, you got to sell it to qualify for whatever sort of healthcare is around at that time in order to not have assets or pay for something different. And it definitely made me think about it, because obviously when it's your parents, you think about it much more closely, and realize that if we screwed this up, they'd be living on my couch or kicking me out to live on the couch. So that is something that really flipped a switch for me. If you're a bad investment on paper to the bank, they won't approve you to get your equity out. And so if you're not putting it to work earlier on, the conversation definitely changes, and it's kind of, you got to get approval to get your own equity out. And that's my last point on that.
Yep. Bobby, as a veteran, you'll understand this. If you're a regular person, the strategy is great, incredible, amazing. You can optimize almost all of your equity. If you're a veteran, you can use the strategy perfectly with literally every single dollar. Not risk a single one of your own dollars, the maximum. So veterans can just optimize the strategy the way everybody could before 2008, and they deserve.
Finally, we get something.
They deserve it. They deserve it. All right. Well, this has been episode 188 with Charlie Jewett and Bobby Alford, and we're going to keep going with cash flow and investing strategies for real estate investors the next time. And why do we do this and spend all this crazy time and speak in front of walls full of Spanish verbs? Because we think you people are the best.
The best. We'll see you next time. Bye.
Thanks so much for listening to Renovating Retirement. We hope you enjoyed the episode. If you have time, please subscribe to the podcast and consider rating and reviewing the show. That will help others find us. And for show notes, resources mentioned, and to connect, head on over to renovatingretirement.com. Thanks again for listening, and we'll catch you next time on Renovating Retirement.